Hey there, fellow Forex traders. Cecil Robles here, and happy Saturday. Hope you're enjoying your weekend, family, friends, football, whatever you have going on this weekend. I wanted to come to you on Saturday because I wanted to share some things with you about the market, what took place on Friday. I've been doing some analysis today, looking and planning kind of for the week ahead for my own trading, and I wanted to share that with you today. On Friday, I put out a video. I got it a little bit wrong. Sort of. Now, I want to explain that for you. If you haven't watched that video, you can go back and watch it after this. But essentially what I did was I said, hey, I believe that the market's going to come down into here. We did some analysis on the daily chart. We looked at how the market seemed to be moving up and potentially breaking to the upside for the euro. And what basically happened here was, of course, we see that the euro broke absolutely below this level, this 113.35 area that I had said between the 113.35 area and this area right here where we have some structure support on this 1 hour chart. I said, listen, we're going to see a pullback after the Fed thing happened. That happened right here. We got the pullback, and I said, if the market gives us a reversal signal here, then we need to look to buy this particular market and go long even more, because I'm already long 2 positions on this market on the daily chart. So we can go on an intraday, more of a short-term type trade, and we can get long here on the 1 hour chart, add to our position, and actually make some more shorter-term profits here. Well, we did not get a reversal signal, as you can see, when price broke down to these levels. We actually got completely the opposite. We got a breakdown below these levels. And you can see the last 2 hours of the market, it really took off to the downside, and we had a little bit of a pullback in the last hour, the very last hour did. But you can see now that we've come down into these structure lows here, right? We've come down into this area, fractal average breakout low, bottom point right here is right at this level. You can see that. If I move this down right there around that area, we came down, tested those lows, bounced off of it. Okay, so here's the thing. I want to give you 3 keys, first of all, for you to live by in the event that your analysis doesn't pan out. All right, we did everything right. We looked at the daily chart. The daily chart was pointing to the upside. I mean, we've already taken 2 long positions on the daily chart. The Fed came out and announced that they weren't changing rates. That's obviously going to be bearish on the dollar and bullish on other currencies for the moment. So we were right in our analysis. I didn't take a trade in this, but had we had a reversal, I would have taken a trade. So that's why I say I was partially wrong. I was wrong in my analysis, but sometimes that happens. So I want to give you 3 keys first of all, and then I'm going to give you some more analysis to what we can expect into this next week potentially. So first of all, 3 keys. Number 1, if you're wrong, cut your losses short. All right. If the market doesn't do what you think it's going to do, and you've done the proper homework, you've done your analysis, and it doesn't do what you think it's going to do, you can't be right 100% of the time. So you've got to learn to cut your losses short. Every great trader tells you the same thing. Cut your losses short, let your winners ride. Cut your losses short, let your winners ride. But a lot of times what happens is we get married to our own ideals and to our own analysis and to our own goodness and so on and so forth. We get married to our own genius, so to speak, right? We think that we know everything there is to know, but we have to come to the conclusion and humble ourselves and say, man, I was wrong in this particular trade. I need to cut my losses. I need to get out. I need to look for another opportunity, right? That leads me to my second key here when it comes to being wrong in the market. And the second key is don't overtrade when you're wrong, or what I call revenge trading. A lot of times newbie traders will come into the market and they will overtrade or they will revenge trade when they lose on a trade. Why do they do that? Well, quite simply because our emotions want to get that money back. We want to make that money back. I mean, human nature is greedy and fearful by nature, and so the greed juices kick in, the fear juices kick in. We hate to lose. We hate to lose money, right? So that all kicks in, and you have to override that. You have to say, listen, I'm not going to revenge trade. And the key to doing that is to always remember, opportunities are limitless. Your capital is not. Therefore, protect the capital. Let me say that again. Opportunities are limitless. Your capital is not. Therefore, protect the capital. There's always going to be another opportunity that comes around. There's always going to be another trade that we can make a lot more money than we lost on, all right? And that's really the key. And that's why we cut our losses short and we let our winners ride, because we want to keep our losses small. We want to get our gains as high as we can, and then we want to be as consistent as we can in that ratio of our win-to-loss ratio, right? We want to stay above that 50% level as much as we possibly can. Hopefully above 60% or 70%, but I'm just saying, if you have a positive reward to risk ratio and you keep your consistency above that 50% level, you're going to be a profitable trader. There's no doubt about that. So I was partially wrong in this. I didn't actually take a trade, full disclosure here, because I did not get a reversal signal here. The market just broke down. Now, I'm long on the daily chart, so we need to go up to the higher time frames and we need to see what's going on. First, we're going to go to the weekly chart here. And we need to understand why this happened, right? Why did the market just break down in the last 2 hours of the trading day on a Friday of all days, right? I mean, usually it's pretty quiet. Well, on Thursday, what happened? The Fed came out, they said that they weren't raising interest rates, right? This is what is called a dovish stance, and it immediately had an impact on the market. Now, on Friday afternoon, the European Central Bank policymakers noted that there was still a lot of risk in the global economy. Now, I want to show you this article here on Bloomberg and read this to you, but it basically says the European Central Bank policymakers noted risks to the global economy following Thursday's Federal Reserve meeting. The shared currency drop against most of its peers after Benoit, an ECB executive board member, said the Fed's decision to leave interest rates on hold vindicates, key word there, vindicates the ECB's assessment of the uncertainty surrounding the global growth outlook. His peer on the ECB board, Peter Prayet, said in an interview with the NZZ newspaper, the central bank should be ready to act if economic shocks turn out to be long-lasting. What does all that mean? It basically they're basically saying here that we're ready to create more stimulus. We're ready to weaken our currency even more if it comes down to it. We're ready to print more money. We're ready to put more money into the economy, thus weakening our currency, but potentially boosting our economy, right? And notice here that they said that the Fed's decision to leave interest rates on hold vindicated their assessment, meaning that they've been right all along. That's what they're trying to imply, that they've been right all along. And basically, they ended up trumping the U.S. Remember, I've been talking about this for more than 3 years now, but and even longer than that, since back in 2007 when I released my book, How to Profit from the Falling Dollar. But I began to talk about currency wars even back then, but especially in the last few years, we have been in a currency war environment, no doubt about it. And what these guys are trying to do, once again, is keep their currency weak. That's what the euro wants to do. They want to keep their currency weak because they want to try and stimulate their economy. They want to export more. They want to create more jobs. So they've got to keep their currency weak so that they can export for cheaper, and their cost of goods are cheaper, therefore stimulating their economy, getting more jobs, creating more jobs. I've expanded on all of that in other videos. I'm not going to go into it again. But essentially, that's what they're doing here. Now, you can also see down here, it says that hedge funds and other money managers boosted net bearish bets on the euro for the third week to 84,202 contracts, according to data from the Commodity Futures Trading Commission. Okay, so we see there that the big guys, they're loading up to go even more short on the euro. Okay, so we've got to go back to the weekly chart. Now that we kind of understand the fundamentals behind it, we've got to go back now to the weekly chart because we want to begin to look at what we can do going forward. If you're a long-term trader, I'm going to give you some outlook. If you're a medium-term trader, I'm going to give you some outlook. And if you're a short-term trader, I'm going to give you some outlook. So here we go. This is what I'll be looking to do if I decide to take a long position or a long-term position here. This is what I'll be looking to do. Essentially, you've got a tight range-bound market. I want to draw a couple of horizontal lines here on this chart, but essentially we've got a tight range-bound market here. Right in between the 108 level, right? right about here at 108, and right here at the 114.65 area, 1.1465 area. You can see that price failed to go up above that area, the 114.65 area there, came back down. It went above it, but look, this week closed below that 114.65 area. This was like a 600 pip swing right here. It went up, then it came down about 600 pips. It went up to 117, a little over 117, came all the way back down to a low here of 111.54. So, I mean, we're talking about, you know, like a 550 pip move there. Then we have here, what happened? Price bumped right up into that 114.65 area this week with a high of 114.59 this past week, and it could not sustain a break above that level or a close above that level or even a close at the high of that level. We didn't even sustain that. So we're bouncing right off of that level. So what does that tell us? That tells us that we're still potentially in this range-bound market here. We're still looking at potentially going back and forth between these two areas. Once again, here was the low here of 108, roughly around that area, 108.18. Here was another low of 108.07. We have not been able to break that all the way back since May of 2015. And once again, since May of 2015, we've been at that 114.65 area. So, you know, for several months now, and actually even further than that, because if you go back to where we actually did trade above that 108 level, that was back in April. So now from April all the way to, you know, past the middle of September here, we've not been able to get outside of this particular tight range here of 114 and 108, about a 600 pip range there. So basically, what is that telling us? That's telling us that if price breaks below this low here, 112.13, it's probably going to go all the way back down to this 108.03 level, right? We tested a third time. If price breaks above the 114.65, it's going to go up. It's going to go up to that next level that I talked about already, about the 122 to 123 area, somewhere around there. It's going to go up to that next level, at least the 117 area, and test that high again. But more than likely, it'll go up to the 122, 123 area over the long term if we can break above this 114.65 area. If we can and we break below this 112.13 area, then we're looking to go back and test this 108.03 area. And so that's my prediction for the long term. If you get a break below this 112.13 area, you want to go short, you can do that. Now, it's a fairly decent reward to risk ratio, not a great reward to risk ratio. This is a cool little tool right here, but essentially we can determine the reward to risk ratio right here. We've got an entry right here. You know, let's say we enter the market. Let me get this down a little bit, around a break below this 112.13 area, and I'll take this high and put it above that 114.91, somewhere around there. We'd have an entry there, and if we traded down here to this area, this should give us the calculation here in just a second. We should see the reward to risk ratio. You can see it about a 1.34. Not a great reward to risk ratio, but it's still above a 1, right? So if the price breaks below that 112.13 area, we can expect it probably to go down to the 108 area, test those lows again. We've got a 1.34 reward to risk ratio, still above a 1, all right? As long as we keep it above a 1, and as long as we're right more than 50% of the time or 50% of the time or greater, then we're going to win in this game over the long term, all right? So that's really a key there. So for the long-term trade, that's what we're looking at. Now, let's go for more of a medium-term trade. We're going to look at the daily chart, and we're going to look at that. For more of a medium-term trade, you can see once again, here's what I was talking about. We were long from back over here. A break above this high right here got us long. Stop loss is very tight on that one, so a very tight stop loss. And then price kept trading up. We got another signal to go long right here above this high, break above that high, and another one to go long with a break above this high right here. All right, I'm in two positions on this on the daily chart, from back here and from right here. One's positive, one's negative, okay? So here we go. Based on this engulfing bearish candle here, and based on the weekly analysis that we just did, a break below this area on this medium-term chart, this 112, the low here of 112.69, is probably going to send prices back down to test this 1.1075 area, somewhere around there. Possibly we could see a rally all the way down, a breakdown all the way to the 108 area. Now, that's a pretty big trade to have in this particular market environment on the daily chart. So I'm not as interested in that. I mean, we're talking about, we've got to have, a pretty good size stop loss on that. If we enter right here around 112.60 with a stop loss above 114.60, and if we just came down here to these areas here, I mean, we're looking at an inverted reward to risk ratio. If we go all the way down, of course, to here at the 1.08 area, now we're looking at a pretty nice reward to risk ratio of 2.25. But once again, that's if price drops all the way down there. There may be better opportunities for us in other currencies to look for. But once again, and we don't even know. The market could rally back around this next week. So that's why I'm saying, if you're long the euro dollar on the daily chart, then I would definitely tighten my stops up to below this low right here. So somewhere around that 112.60 area, somewhere around there below this low. The low here is 112.69. Might want to put it at 112.49, give it about 20 pip. Check stop there is what I call it. So you got about a 112.49 stop loss on that. Tighten your stops down to get, to cover your long positions if in case the market does break down that way. A better play here. I'm going to give you the better play for more of a short-term play, an intraday type trade, and that's going back to this 1 hour chart. This is actually where we can see some great reward to risk ratio if the market indeed does continue to trade down. And that is by buying or by selling these corrections here. So we were looking to buy here if we got a reversal based on structure in this area. Now, we've hit structure somewhere else here. We've hit structure right down here at this area. You can see these lows right here. This is structure, support now at this area. And you can see Friday we traded right down into it. The very next, the last hour of the day, it came back up off of that area. So what I would be looking to do is see some movement back up to this upside and for price to trade back up around this 113.50 area, possibly back up to the 113.60 area, somewhere around here. I'd be looking for some kind of a reversal pattern at this particular point and place a stop loss. If I get a reversal, place the entry, place a stop loss back up here above these highs. So if we do that and we look at, and we go short position here, and we look at a short position now on this with an entry somewhere, around this area and a stop loss somewhere, above these highs here, maybe like right here, and now a potential of going back down and testing these lows here of the 112.13 area. Now we're talking about a nice reward to risk ratio. Look at that, a 4.45 reward to risk ratio. Now that is what I call a very nice reward to risk ratio. And once again, that would probably pan out just from the standpoint of, even if we did a fib retracement and price traded back up into this area, you can see here between the 127.2 and the 161.8, where is that? That's right there at that area that we're looking at, that 112.13 to 112.20 area. Look at that reward to risk ratio. Now we're talking about a great reward to risk ratio. Now we'll have to see where all this pans out, but this is what I'd be looking for in the week ahead. All right. So hope you got something from this analysis. Remember, make sure and keep your losses short. Cut your losses short. Don't overtrade. Remember, there's always opportunity. We also did some analysis on the pound yen, so I'll go over to the pound yen real quick and we'll look at that. Here's the 60-minute chart on the pound yen. Once again, I still believe that the pound yen could be bearish here. I think the pound yen can still remain bearish. Notice, if we go up to the weekly chart, we're still in a bull market. As a matter of fact, we've had a nice, what we call a continuation trade on the weekly chart coming into here. And you can see here this continuation trade came down below our 50 exponential moving average line, the Williams percentage range, boom, right there, and price broke above that high there. So I'm still looking for prices to go back up, and test this area. I still think we can come back up into these, the 194.50 area, somewhere around there. But we'll see. Look at the daily chart, the 1 hour chart. What I had said was if price comes down here, test this low right here. This is where we have structure support. You can see, look at all these lines right there from our FAB indicator. We've also got the structure support right there. And if we go back, you can see that we've got structure support right here. So that all coincides together. Also, if we do a little Fibonacci analysis here, you can see where we come into is right here into this 61.8% fib, somewhere right around in there. So if we get a reversal down here and we can't break down below this with a consistent close below it, then once again, we can see a nice opportunity to buy right here in this area. And I'm sure our reward to risk ratio will be enormous if we can buy down in here, looking to shoot back up to these highs of 188.14 with a very tight stop and, tight being relative, but I mean somewhere down below this low here, depending, and with a target up here above this high. Also, a couple of other currencies that I like. Pound CAD. I like long in pound CAD, especially if you look at the daily chart. Daily chart has been in a nice massive uptrend. We've had a continuation trade right here. Could have got long on this right here, actually. Long here. Failed continuation trade right there. Not quite failed because we would have had our stop down. We would have had our stop down a little bit further than that. But next one right here, could have got long right here, been long in this market. I'm currently long and up in this particular position. And you can see that we had a pullback here, but look at where the market closed. Closed very bullish on this close on the daily chart. So we're looking for price to continue to the upside. Now, why is that? If the global economy is still teeter-tottering, if it's still in a slowdown, why would we be looking to go long the pound and short the CAD? Well, from a fundamental standpoint, if the global economy is still, teeter-tottering, if it's still, not quite strong enough yet, that does not play favorably for commodities, okay? And the Canadian dollar and the Canadian economy is a extremely commodity-driven economy. Same with the Australian dollar, right? So these two particular currencies have suffered significantly because of the fact that, once again, these economies run on commodities, and the commodity prices have been extremely low, and that's created, obviously, a damper on their economy. So that has created some weakening in their currency. And we're going to expect that to continue until, once again, we see that there is a shift in policy between these major central banks, the Fed and the ECB and other major central banks around the world, but mainly, and the majority being the Fed and the ECB, of course, being the big ones there. And so we're still looking for long positions here in the pound CAD. Euro CAD, same thing. If we look at the Euro CAD, once again, I got long in the Euro CAD on a 4-hour or on a more short-term trade. Didn't quite hit my target, but I'm still looking to stay long in this particular pair here. Still think we're going to see some strength there in the Euro CAD this next week based on that those weakening statements from the Fed and the ECB. So still have some time for the 50% off deal on our Currency Signals Club. If you like these analysis and you like to get even more, you like to get our signals sent to you on a daily basis, then you can join that. It's 50% off for a lifetime membership right now. The price will be raising back up to normal prices after this promotion ends on Sunday at midnight. So take advantage of that if you'd like to. I'll see you next week. We'll be back with some analysis.